if Australia's banks, as we are told by everybody, are sound, everything is safe, and we've got no reason to disbelieve that, in that case, if things are normal here, the Reserve Bank should make normal interest rate decisions. As you point out, if that means going the ongoing fight against inflation, there's no reason not to do it. There's no reason to pause and look at what happens around the world, because broadly, even what's happening around the world right now is not going to have a significant impact on Australia's banking system.
It seems contained. I mean, the Credit Suisse issue really is an institution-specific issue. Yes, there's this problem with second-tier banks in the US, but the authorities are moving quickly there. But I think the other thing is we're now in a new stage of the tightening cycle where instability is now really starting to emerge.
But that's what's supposed to happen when you raise interest rates as aggressively as you have.
Yeah.
That's what you're trying to do. You're trying to change behaviour. And yes, the pressures of those rate rises are going to squeeze some weaker players out.
And I think we're actually still at the beginning of that process. I think there's going to be a lot more financial instability, a lot more events in the 6 months ahead, while these central banks still have to, they may pause, but they're not cutting. That's for sure. And I think the Europeans showed that. And I think this is why the Fed is so important tonight. You know, given how far money markets and interest rate markets have rallied and implying rate cuts within months in both the US and Australia and other markets, the Fed's communications tonight are critical to really put to bed that idea that they're worried about this financial instability and that's going to change the course on their interest rate policy. No, they're focused on inflation. And I think the most important thing the Fed tomorrow is going to do is remind the market of that.
So they raise interest rates to head off inflation in the United States, but at the same time, they kind of rescue the depositors in Signature Bank, Silicon Valley Bank, and it remains to be seen what happens to First Republic, though its share price did recover. So, you can't ultimately save everybody, though. That's the point. The taxpayers can't step in and effectively underwrite every deposit in every bank account in America.
Well, they certainly can't, although that being said, there's lots of ways they can continue to provide liquidity to the banking system. They're acting aggressively because this is the banking system. This is actually a genuine concern over a run on second-tier banks. My view is that the financial distress we're going to see in the months ahead is going to be outside of the banking system. And we've already seen crypto, FTX, that sort of thing. I think we're going to see issues arise in other parts of the financial system, which they will not bail them out, and they will have no technique or tool to do that either.
So in other words, interest rates rise, and so something else pops out there. Property developers, it could be. People who own office buildings in big capital cities could be another one as an obvious one to see. We know the construction industry is under pressure, so all these things are real.
Yep, and investors are going to be watching all of this. It's going to be a very edgy, volatile few months ahead. And the reality is that no one can be confident that this fight against inflation is won. In the United States, they were literally talking about upping the pace to 50s 2 weeks ago because the payrolls have bounced back in 2023, inflation stopped falling at 5%, and here in Australia, we haven't even seen the turn in inflation. And we have no visibility of how far it's going to fall.